Buy the fear, sell the greed. We've all heard it. And right now, fear, it's on full display. It's a window to stack and a chance to spot the next big thing, because while altcoins are chasing hype, few projects are quietly reshaping the rules. Quai Network says they've started from scratch, not to patch crypto's problems, but to revive its original mission.
The point of Quai is to really fulfill the original vision of Satoshi laid out in the title of the white paper, P2P Electronic Cash. Fundamentally in that statement, he's saying that he wants to separate money from the state and empower individuals and have individual freedom through having an independent money system.
A bold claim, absolutely. But this isn't just another weekend project. It's the result of nearly a decade of engineering to compete at scale.
We spent about 7 years figuring out how to do this, but high level, from the characteristics of it, we designed it to compete with Visa.
And if just one major city were to adopt it at scale, the transactional potential could eclipse the entire crypto space.
If you got one city like Istanbul to adopt it, even to the level of say like 20 or 30%, you would actually be 10 times bigger than all of crypto combined transactionally.
That's why today we're sitting down with Dr. K, the CTO and architect behind the vision, to find out what really makes Quai Network different. Is this just another ambitious white paper, or the foundation of something much bigger? Ladies and gentlemen, let's dive in. Let's get into it. Dr. K, thank you for joining me. Why don't you just break down for us, why Quai?
Yeah, so the point of Quai is to really fulfill the original vision of Satoshi laid out in the title of the white paper, P2P Electronic Cash. Fundamentally in that statement, he's saying that he wants to separate money from the state and empower individuals and have individual freedom through having an independent money system. Unfortunately, in the interceding 15 years, the crypto industry has kind of failed technologically to deliver that. So what we've done at Quai is from idea to launch, we spent about 7 years figuring out how to actually solve the technical problems to deliver a system that can function as a parallel monetary system. So the point of Quai is to actually make a system that separates money from the state, that's fully decentralized, fully independent, and fully uncontrolled.
So, Dr. K, a layer one, especially trying to fulfill something like Satoshi's vision, peer-to-peer cash, is a huge, huge lift. Everything sounds great so far. Congratulations on your success so far. But really, how does one, come in 2025 now and try to step into the playing field to become something like a peer-to-peer cash?
Yeah, great question. So what we're focused on is getting adoption through people that have a problem that really only we can solve. So sort of today, right? So a couple of examples of that are when you look at sort of Web 2 businesses, one of the problems that they have with Web 3 is that they don't have sort of fixed pricing, and certainly not over time. So if you go to a company and you say, you should go on chain, and today your costs are going to be a penny to do a transaction, but in the future that same transaction might be $100. They can't really commit to that sort of variability in cost structure. So one example that we have is we have a company called Frictionless Markets, which tokenizes assets for investors and family offices. They have pretty interesting sort of constructs where they sort of tokenize like bonds, and then they use the interest to go risk long, crypto tokens, things like this. But one of their things is the fees on just creating even these financial instruments are highly variable and different over time. So, they're almost more expensive in some ways than traditional TradFi. So having to pay, $100 to deploy sort of an NFT that represents these bonds using their contracting system doesn't actually sort of, help them on a cost structure basis. And that's in finance too. So, they've deployed on our chain for that reason. And there's other examples of that too, like Rarible, they do NFTs. They approach companies like Mattel to do points and rewards. And they sort of have the same problem where they go to a company and company says, I need to know the cost for minting 1 million NFTs. if today it's $10,000, but tomorrow it's 100 million, they obviously sort of can't commit to that as a long-term business model. So that's sort of one set of consumers. Another set I think that is super interesting is the people who are suffering from inflating nation state currencies. So if we take Buenos Aires as an example of this, Buenos Aires obviously has the Argentine peso. The Argentine peso has had a pretty severe inflation over the last 5 years. And a lot of Argentinians have been trying to adopt crypto as a mechanism to escape that inflation. And they were even trying to adopt it transactionally. So they started out maybe 4 or 5 years ago using BNB and USDT on Binance Smart Chain. And then the problem was fees sort of went up on Binance Smart Chain. So they were paying $1. They could no longer use it transactionally. So then they shifted over to Tron. And they said, okay, well, we're going to do transactions using USDT on Tron. And then the fees went up on Tron and they got priced out. So now what happens in Argentina is people still use crypto, but they use it sort of as an offshore account. They just kind of have a wallet. They'll hold some Bitcoin or Ethereum, in that wallet. But then when they go to spend it, they have to go through one of the local exchanges and buy Argentine pesos, and then pay the fees for doing that. So basically, crypto has failed in that system, even though there were millions of people that were trying to use and adopt it. So sort of our thesis is, if you go to somewhere like Argentina or Lagos, Nigeria, or Istanbul, Turkey, or Bangalore, India, you can actually go into these places where you have relatively high crypto adoption and interest in transactionally supplanting the nation state currency, and go to market there. We have some interesting ways of potentially getting adoption through some tiered referral schemes in the wallets. But we think that there's a mechanism by which you can penetrate those markets.
And do you think that would be kind of the first killer use case for Quai?
Potentially. I mean, if you got one city like Istanbul to adopt it, even to the level of, say, like 20 or 30%, you would actually be 10 times bigger than all of crypto combined transactionally.
Yeah.
So like when we talk about crypto and we talk about use cases and we talk about going to 1 billion users, like the way you get to 1 billion users is cash. The way like you understand how niche crypto is one city with marginal adoption is 10 times bigger than the entire industry combined in terms of transactions. Mm-hmm. That's crazy, right? It's like this is a completely different market. Yes, it's hard to maybe sort of skin this cat, but it's not even in the same ballpark as what currently exists.
Yeah. So I've talked about it on my channel oftentimes. That's Satoshi's vision still hasn't been fulfilled, and I still believe that there's room for that. So maybe you can explain a little bit how infrastructure then is different than Bitcoin. Bitcoin, like you said, Satoshi wanted to be peer-to-peer digital cash. My belief is that, the block wars, had something to do with it, but still, I don't know if we had bigger blocks, if 10-minute transaction times would still satisfy people's desire for peer-to-peer digital cash. How is your infrastructure different than Bitcoin?
Yeah, so like I said, we spent about 7 years figuring out how to do this, but high level from the characteristics of it, we designed it to compete with Visa, right? So we have 5-second block times, which gets you sort of 8-second on average confirmations, which is competitive with what you see when you you tap a Visa card. So when you go to the store, you tap your Visa card, it's about 8 seconds between when you tap it and it says accepted. So that was sort of our design criteria. The other design criteria is what scale you need, what number of TPS you need to do. We came to a number, if you want to globally be used as money, you're looking at least 50,000 transactions per second. So we were able to, come up with a novel architecture, a novel consensus mechanism that's able to scale proof of work to that level of throughput without sort of creating centralization. So those are the sort of the things that we bring to bear. And then the other thing is that maybe isn't as obvious is 70% of transactions by value currently are happening in stable tokens. So one of the things that Bitcoin doesn't fulfill is the need to be able to have a stable referential asset, which you can price goods, services, and contracts in. So in our system, we have 2 tokens. We have Quai, which is sort of your EVM programmable, deflationary, volatile token. And then we have Chi, which we call an energy dollar. And it brings two new properties to the system. One is that it is a stablecoin alternative that has relatively consistent purchasing power with time because its value is tied to the value of producing hashes for the miners, the energy costs. And then the other thing that it does is it has cash-like privacy properties. So in this system, when we're talking about creating an independent system, we're really talking about creating an independent monetary system. And to create a monetary system, you need three things. You need a store of value, which Quai delivers. You need a unit of account, which you get from the energy dollar with its stable characteristics. And then you need a medium of exchange, which you achieve through the cash-like privacy properties of Chi. So we're actually trying to design that independent monetary system, not just sort of another crypto.
That's really fascinating. So the Chi token, it's essentially pegged to the cost of producing blocks on the network. Is that right?
The cost of producing hashes.
Hashes. Okay. And so, and then as the mining becomes more difficult by more people participating, the cost of producing those hashes would go up. Is that right?
So the cost of producing a hash remains the same. The cost of producing a block goes up. So if you were sort of taking Chi as your mining reward, you're actually getting more Chi per block as the difficulty rises.
Well, my question is does Chi then remain, you said it's relatively stable. I'm curious, I know that the cost of, like, for my reference point is Bitcoin, right? So I know that the cost to mine a Bitcoin usually goes up over time as the network gets more competitive. And so if you were to peg a coin, for example, the cost of mining a block of Bitcoin, it would go up over time, likely. How about Chi? Is it gonna, the purchasing power, will like one Chi always buy a bottle of, I don't know, Evian water or something?
Yeah, that's the idea. Is it's designed so that one Chi sort of is always buying a bottle of water is exactly how it's designed. I think the thing that you're thinking with the block is, as the difficulty goes up, it's more expensive to mine a block, but the number of hashes that go into the block is proportional to that expense. So Chi is emitted proportional to the number of hashes you produce. So if, say, the starting difficulty is 1 million, so to speak, maybe you get 10 Chi for that block. If it goes to 2 million, you'll get 20 Chi for that block. So the block reward goes up proportionally with hashes, which keeps that sort of value consistent.
And how does one mine? And then if I am mining, am I mining Chi or am I mining Quai?
So you get a pick as part of the market mechanism. So as a miner, for any given block, you can set your miner to mine Quai, mine Chi, mine some ratio between the two based off your desire for Quai versus Chi. So when we're actually talking about sort of how Chi maintains the value, it's actually all market mechanisms. There aren't actually really pegs in the system. So the miners are part of that market mechanism where they're trying to optimize their total, return on investment of their electricity, and they can do that by rationally picking Quai or Chi depending on relative values and market demands. So there's both speculators and miners in the system, which are what actually causes the convergence of Chi to its cost of production.
Okay, so now for anyone watching or myself, I'm actually very curious because I really regret. I was in Bitcoin in 2012 and really got into 2013. I really regret not mining it. Like, that was dumb. I should have done that. So if one were to mine on the network, could they just use their normal computer? Are the ASICs mining? How much hash power is currently being generated by the network? Out of all proof of work chains, where do you guys sit on like the hash rate?
So for the first question, if you want to mine the token, you can run a node and you can mine with a GPU. So it's a GPU friendly algorithm called ProgBow. If you don't want to do that, or you're not quite that technical, there's also sort of one-click deployment solutions that we have with cloud partners. So like Akash, IONET, and Clore, you can just go do sort of like a one-click deploy, buy the hash rate you want, and it'll just mine for you.
Does that use my own GPU?
So if you use Clore, you're actually renting hash rate. on the network.
Okay.
There's also pool mining. So if you don't want to actually run the node, but you just want to mine with the GPU you have, it's Stratum compatible. You just enter one of the pool endpoints, F2 pool, Hero Miners, K1, all support Quai. You just put one of those endpoints in and you can mine to a pool as well. So those are all the different ways you can mine. In terms of the hash rate, right now I think it's about 2 terahash, and we're like just I think in the top 10 of proof of work tokens.
Okay.
But we've only been live for about 6 weeks, so not doing terrible for the youth of the token, I guess.
So, for those watching, I think, there's going to be a lot of people, interested in, potentially speculating here on this. And I know that I'm not asking you to talk about price or anything, but I am curious about the community. And, I think one of the things that probably made Caspa have a strong community was that a lot of people got involved when it was cheap and early, and they, held, and now they've got this like pretty cool cult-like community. I'm curious, do you have any metrics on how many people are running miners now individually by any chance? Not these big, huge, mining farms, but like the community size, I guess we could ask more or less.
Yeah. So presently in mainnet, we don't have as good of a metric on where the hash rate's going because of the pools. But in testnet, our last testnet, we didn't have pooling. So our last testnet, we sort of, I think, averaged about 600 gigahash because it was sort of an incentivized testnet. And there was sort of a claims process. So we had a better idea on the number of people. And I want to say it was about 8,000 independent miners were working in the last testnet. And then obviously we have about 4 or 5x that hash rate now in mainnet. So maybe that scales proportionally. I'm not quite sure. But at least 8,000 independent individuals were mining in the last testnet. So maybe we're on the order of 20, 30,000 miners.
Oh yeah. Can you tell me, Dr. K, can you tell me about the emissions rates? Or usually when these proof of work chains start off, there's usually a quite high emissions rate. For anyone who's watching, what kind of inflation can they expect over the next, let's say, 12 months?
Yeah, so the inflation rate is actually a little bit dynamic because it's sort of determined by the market and the miners themselves. But presently, you're looking at, I think, around a 15% inflation rate this year at the current numbers. One thing that this system does is instead of sort of having like an arbitrary like halving cycle, the emissions of Quai is proportional to the logarithm of difficulty, the binary logarithm of difficulty. So effectively what that does is every time the difficulty doubles, it's effectively putting a halvening in, but it's dynamic. So if hash rate goes up, like halvenings are happening. If hash rate goes down, they're kind of like unhappening, so to speak. But that sort of dynamic relationship actually acts for a much smoother sort of emissions process. So you get less sort of booming and busting as the network grows with Bitcoin, right? So if you look at sort of the pricing of Bitcoin, sort of the disbalance in stock to flow due to the halvenings on those arbitrary 4-year cycles are why we see these like manic, buildups in price and crashes. Basically, we're taking that curve and sort of making it continuous, if you will. And then it adjusts to the difficulty of the miners. So it's responsive to the market. So you're always kind of trying to match stock to flow. And so one of the good aspects of that is you should get less volatility in pricing over time, which then means if you think the network's going to grow, you don't necessarily have to time your entries as precisely relative to the cycles, because the cycles shouldn't really exist as much, so to speak. So it should just kind of be like this meandering path up rather than these huge peaks and troughs.
So when I look at the, let's say the FDV, is that measured by the total coins that will eventually be mined? I guess that's the 3 billion. Is that right?
So there's a genesis piece to this, and then there's the mined piece to this.
Well, how many tokens will there ever be?
So there's a tail emissions in the system. So the inflation rate trends to 0, but it never goes exactly to 0.
Can you give me some sort of short-term, mid-term time frame? Say in the next, I think it took Bitcoin, what, 15 years to mine 90% of the supply? Is there some kind of number you can give me to give me some type of understanding?
So I think like it would probably be like the 10-year point is probably a good reference.
Okay.
And sort of depending on how fast the network grows, at what hash rate, you'll see somewhere between, say, 7 billion and 15 billion tokens at 10 years. But again, it's a dynamic number. That's why I can't give you like the real number, but at 10 years, that would be a reasonable range.
Is it 3 billion pre-mine then?
Yeah. So that's, it went to paying the VCs for the seed funding. There's a foundation component to that, team, et cetera. So, and then there's obviously social. So there was like social incentives and testnet incentives and all those things. So it was all sort of like the pre-genesis activity, so to speak.
Sure. Okay.
Yeah. Now, all of those are like locked over periods of time. All the investors in the team are on like a 1-4, vesting with Cliff. And foundation tokens come out over like 6 years. Yeah.
All right, Dr. K, that's all the time we have today. Thank you for coming on. Really appreciate it. Very, very interesting. And I'd probably like to do another one because I have a bunch more questions.
Well, I appreciate it, Kyle. Thanks for having me.